Welcome to the Opening Bell Report.
We're looking at an investment report on Applied Digital, APLD, titled 250% Revenue Explosion, Why APLD is Just Getting Started. It focuses on their pivot to AI cloud hosting and a huge Q2 revenue beat. Let's get right into the analysis.
Yeah, that title is definitely eye-catching. The revenue numbers are impressive, but I think we need to immediately drill down into the cost of that growth. That's where the real story is.
Let's do it. So the analysis creates a compelling narrative around the explosion of revenue, but risks underplaying the sheer scale of the capital intensity required to achieve it.
Exactly. That's the perfect way to frame it.
So, what's the specific disconnect you're seeing in the report structure?
Well, the weakness is really about placement and emphasis. You see the $126 million revenue beat on page 1. It's in bold. It's the triumph.
Right. It's the good news up front.
It is. But the $552 million in CapEx, the actual cost to build the thing, that's buried way at the end in the risk section.
So you're saying by separating the success from the cost, it paints a picture of success without context.
It's like talking about how fast the Ferrari is, but, hiding the fuel bill in the glove compartment. It creates a skewed perception from the start.
I see what you mean. The reader gets that dopamine hit from the growth number first, and by the time they see the bill, their mind is already made up. It's a psychological anchor.
Exactly. So the suggestion is to integrate the cost of growth analysis directly into the decoding the explosion section. You have to create a more balanced financial picture right away.
You can't treat CapEx like a footnote in a data center business.
It's the engine room. It's the entire business.
Okay, I like this. It shows a more mature financial understanding. So practically, how does the author weave that $500 million number in without, killing the bullish momentum?
Well, there are a few concrete ways. First, when you talk about the Q2 revenue beat, you immediately put it right next to the cash burn rate.
Side by side.
Right. Don't let the reader finish the paragraph without knowing that for every $1 of revenue, they spent almost $4.50 on infrastructure. That grounds the excitement in reality, instantly.
That changes the whole texture of the beat. It's not just, we made more money, it's, we made more money, but look at what it cost us.
Precisely. And building on that, instead of just saying things like margins are improving, actually calculate the return on invested capital, the ROIC.
For that specific quarter.
For that quarter, it would be so much stronger. It answers the real question. Is this $500 million spend actually generating efficiency? Or is it just, bloating the asset base?
That moves the report from narrative to quantitative. It's easy to say losses are narrowing, but ROIC tells you if the business is getting smarter.
And the last piece on this is a runway analysis. The report says something generic like, financing becomes harder if rates go up. That's not enough.
It's too vague.
Way too vague. We need the math. How long can they sustain a $500 million quarterly spend? How many quarters until they need more debt or they dilute shareholders? That's not a risk. That's a mathematical certainty that should be in the core thesis.
That's a great point. It makes the risk a scheduled event, not some foggy possibility. All right, let's move to the second pillar of this thesis, the chronoscale spinoff.
Ah, yes, the hidden gem argument, a classic.
So the thesis relies heavily on the hidden gem narrative of this spinoff, but the valuation logic assumes a best-case market reception that lacks comparative evidence.
It's confident, maybe a little too confident. It basically asserts that spinning off the cloud segment will force the market to value it at, 20 to 30 times multiples.
Just because it becomes a pure-play AI software company.
Right, and that's a massive speculative leap. It assumes the market in 2026 will just automatically reward it with those multiples, but there's no evidence. No recent comps, no similar transactions. It feels like an entitlement, not an earned valuation.
It does feel a bit like magic math, doesn't it? Just split the company and poof, it's worth more. So how do we make the value unlock section less speculative?
The suggestion is to bolster that argument by comparing Chronoscale's projected metrics against actual peers or recent IPOs in the AI space. You have to show your work.
So instead of just saying, software companies trade at 30x, we need to be specific.
Exactly. Reference specific competitors or recent spin-offs that actually got or maybe failed to get that 20x multiple. If a similar company spun out last year and only got 12x, why is Chronoscale going to get 30? You need the bull and the bear case based on market reality.
And what about the mechanics of the spin-off itself? The report is a bit light on that.
That's a huge omission. I mean, is it a tax-free distribution to shareholders, or is it an IPO to raise cash? That fundamentally changes the value proposition for current APLD holders.
Right. One means shares in your pocket. The other could mean delusion.
And the report just glosses over it. But it's absolutely vital for the valuation.
That's a really sharp insight. A spin-off isn't always free money. And what about the parent company?
Well, that's the other side of it. We need a scenario analysis. What happens to the parent company's valuation after you remove the crown jewel?
Does APLD just become a dumb pipe PowerShell?
Exactly. If you strip out the high-margin AI service business, are you just left with a capital-intensive construction company with a ton of debt? The report needs to prove that the remaining part doesn't just collapse in value.
Which ties right back to our first point about that massive CapEx bill.
It's all connected. Suddenly, the parent company is holding a very dangerous bag without the high-margin narrative attached to it.
Okay, moving on to the growth story, the just getting started part of the title. That all hinges on future capacity.
The 900 megawatts. This is where the rubber meets the road, or I guess where the shovel meets the dirt.
The argument that APLD is just getting started relies on the 900 megawatt pipeline, but the report treats secured capacity as nearly synonymous with operational revenue.
That's the execution gap. The report says there's a mathematical path to double or triple revenue. It sounds so clean, like a straight line on a graph.
But construction is never a straight line.
Never. It glosses over all the real-world bottlenecks, transformer availability, permitting delays, grid interconnection queues. These are the things that plague every single data center build-out. It's not just flipping a switch.
It's like the report treats a construction project like a software download. You just click install and the capacity appears.
If only it were that easy. Secured power is just the first step of a marathon.
So how do we fix this? How do we inject some realism into that timeline?
The suggestion here is to deepen the analysis of the pipeline by breaking down that 900 megawatts into phases of probability and readiness. Not all megawatts are created equal, you know?
Can you give me some concrete examples of how you'd structure that?
You have to categorize it. How much is actually under construction right now versus just contracted? Secured might just mean they have a land lease. That's a totally different risk profile than having shovels in the ground.
And then assign a probability to each of those buckets.
Yes. And the report does mention execution risk in the conclusion, but that's too late. It needs to be brought forward. Don't hide the difficulty.
And maybe quantify the impact of any delays?
That's the stress test. You have to provide a timeline buffer. What if the build-out is delayed by 6 months, which is pretty common? How does that impact the stock price target? If that revenue explosion gets pushed into 2027, the whole valuation changes.
That's excellent. It moves the analysis from a best-case scenario to a risk-adjusted reality. Okay, final section. The competitive landscape. The comparison to Core Scientific and Iris Energy.
The comparison table, it's a standard feature in these reports, but I think it kind of misses the mark on why APLD actually wins.
It seems to create a binary distinction between APLD and its peers that may overlook the nuances of the NVIDIA proxy trade.
Right. The table labels APLD as AI first, Core Scientific as Bitcoin mining, and Iris as balanced. And it calls APLD the landlord for NVIDIA chips. But that's just branding, it's not analysis.
It doesn't really explain why a hyperscaler wouldn't just build their own facility.
Or why APLD's infrastructure is actually better than, say, Iris Energy's, beyond just the label of focus. Being a landlord is only a good business if your building is better than the one next door.
It does feel more like branding than a real technical analysis. The report doesn't tell us why the building is the best one on the block.
Exactly. So for the competitive landscape, what's the suggestion?
We need to strengthen that section by focusing on technical differentiation, not just business model focus. We need to move from we're focused on AI to we have the best infrastructure for AI.
Okay, give me the specifics. What should the author be looking for?
Density capabilities. That is the currency of AI. Can APLD's facilities handle higher power density per rack? 100 kilowatts per rack versus a retrofitted mining facility that might top out at 20 or 30.
Now that is a real moat. That's a reason a customer has to go to APLD.
It's a huge distinction. If your racks can't handle the heat, your business model doesn't matter.
Precisely. And then you need to analyze the stickiness of the contracts. Are the tenants on month-to-month agreements or 10-year leases? If the hyperscaler contracts are short-term, that NVIDIA proxy trade is incredibly risky.
That's a great point. If chips become more available, does the landlord lose pricing power?
It's just basic supply and demand. The report assumes the current shortage of AI-ready rack space is permanent. A stronger analysis has to address that risk. If NVIDIA chip supply eases, does the premium for APLD space decrease? What happens when the shortage ends?
This has been a really thorough teardown. We've gone from the financials to the valuation, the construction risks, and now the strategic moat. It's clear the bullish enthusiasm is there, but the arguments need reinforcing.
Absolutely. And look, the 250% growth is a fact. It's an impressive number. But an analysis report needs to be more than a celebration of the last quarter. It has to be a rigorous stress test of the next 4.
I completely agree. The goal here isn't to disprove the thesis, but to make it bulletproof. If the author can answer these questions about the cash burn, the spin-off comps, the delays, the rack density, then the strong buy rating carries a lot more weight.
That's right. Right now it feels built on optimism. We want it built on data.
So to recap the main points for our listener, we have 4 key areas to strengthen this. First, contextualize the revenue explosion with the CapEx reality immediately. Don't bury that $552 million spend.
Bring it right up front. Use ROIC to prove the efficiency.
Second, provide concrete comparables for the Chronoscale spin-off valuation. Theoretical multiples aren't enough. Look at the deal mechanics and the impact on the remaining parent company.
You have to stress test that sum of the parts story.
Third, break down the 900 megawatt pipeline into risk-adjusted phases. Secured isn't revenue ready. Build in a timeline buffer for the inevitable delays.
Acknowledge the bottlenecks.
And fourth, sharpen the competitive analysis. Focus on technical density and contract stickiness, not just the AI-focused branding. The moat is the tech, not just the pivot story.
That sums it up perfectly. It's about moving from a narrative-driven report to a fundamentals-driven one.
I want to thank the listener for submitting this. It's a really compelling topic. And with these adjustments, this analysis could be truly top tier. We would love to see a version 2. Once you've tightened up the risk analysis and valuation models, please send it back in.
Yes, I'd be very curious to see the actual density numbers on those racks.
Until next time.
Goodbye.
Don't forget to like, share, and subscribe for more.